Here's something that shouldn't be possible. Two people can look at the exact same paycheck and both be completely right about what to do with it. One says, save everything, buy a house, retire quiet and comfortable. The other says, that plan doesn't exist anymore, not for anyone. Normally, one of them would just be wrong. This time, neither is. And once you see why, you'll never hear just save more the same way again. Let's start with the argument almost every family has had at some point, the price of a house. In 1980, a typical home cost about 3.5 times the typical income. By last year, that ratio had climbed past 5, but the real surprise isn't even that number, because it's not even the same house anymore. Square footage jumped by nearly 40%, bigger kitchens, more bathrooms, a home office nobody budgeted for in 1980. So yes, part of that price jump is real, but some of it is a completely different product wearing the same label. Okay, so maybe it's not just the house, maybe it's the loan. Mortgage rates back then looked brutal on paper, almost 14%. But here's what almost nobody mentions. Prices themselves barely moved for years, which meant people actually had time to catch up and save for it. A 20% down payment back then meant saving around $13,000. Today, that same 20% means saving past $80,000. What used to take 2 years to save now eats up more than a decade of someone's 20s. Wages since then didn't just slow down. They basically flattened. By age 30, close to half of boomers already owned a home. By the same age, barely a third of millennials do. That's not a vibe. That's not laziness. That's arithmetic. But even arithmetic doesn't tell the whole story. There's one more ingredient no spreadsheet ever lists. Time. Time was the real asset boomers had, not just cheaper houses. $100 invested monthly through the 80s had decades to compound. Millennials are running that exact same formula, just with a shorter runway and a stack of bills the boomer version never had to clear first. If numbers like this catch your attention, this channel is basically built around digging up more of them. But housing isn't even the biggest reason this fight exists. Since 1979, output basically doubled. Pay for that same typical worker? It crept up about a third. If pay had simply kept up, the typical worker would be earning about $16 more every single hour. That's not a rounding error. That's real money vanishing from every paycheck before it's even printed. Picture two co-workers starting on the same day in 1979. One of them keeps getting paid in step with how much more they're producing. The other keeps producing more, and the extra value just goes somewhere else. That second worker is basically every worker after 1979, boomer, Gen X, millennial, all of them. Which means this was never only a boomer versus millennial fight. Two generations, one slowly tilting floor. They just noticed it from different angles. So how did the first rulebook even get written? Picture starting your first real job in the late 70s. The interest rates are punishing, sure, but there's a pension waiting at the other end of the career. One income can often carry an entire mortgage on its own. Sounds almost too easy, right? It wasn't. Wait long enough, sacrifice a little, get rewarded. Do that enough times, and it stops feeling like advice. It starts feeling like a law of nature. Save, wait, it works. That was the whole religion. I keep pulling threads like this apart. Stick around, and you'll catch the next one before it's gone. Now picture starting that same first job in 2010 instead. The pension's gone. In its place, an app, a few fund options, and a hope you picked correctly. Back in the early 80s, 6 in 10 private sector workers had a real pension. Today, that number is down to about 1 in 7. And the job itself doesn't sit still anymore either. Then there's tuition, which climbed more than 400% since the boomer years. Working minimum wage to cover it now takes roughly 5 times as many hours. Add in freelance work, contract gigs, side hustles, income that used to be rare is now just normal to keep pace. None of it comes with a pension attached. So here's what almost nobody says out loud: saving doesn't feel like a strategy anymore. It feels like a joke with a 50-year punchline. So spending on something real, right now, stops looking reckless. It starts looking like the only guaranteed win on the table. Not reckless, rational. Here's where the story flips completely. Federal Reserve data compared millennials to boomers at the exact same age. Not millennials today versus boomers today. Same age adjusted for inflation. and millennials came out ahead, meaningfully ahead. That's the median household, not the ones with rich parents, the typical one. Maybe the story was never millennials are broke. Maybe it's that the money means something different once you actually have it. Almost 9 in 10 millennials are carrying some kind of debt at that same age. Boomers at that age carried debt too, just less of it and less of a squeeze around it. A lot of that millennial wealth is sitting in stock-heavy retirement accounts and home equity, assets that can swing hard when markets turn. Boomer wealth had a pension underneath it, a floor that doesn't move when the market drops. The wealth is real, it's just standing on a shakier floor. If unpacking numbers like that, the ones that flip the whole story, sounds like your kind of thing, this is exactly what I do here every week. This is exactly where the argument actually starts. A boomer sees a coffee run and thinks, that's exactly what I skipped. A millennial hears that and thinks, skipping coffee was never buying me a house at these prices. Same coffee, two completely different meanings. Or take the word sacrifice. To a boomer, it meant skipping vacations for a decade to make a mortgage payment. To a millennial, it means not having children yet, because there's no floor to catch you if it goes wrong. Same word, two completely different mountains. Or take the word responsible. To a boomer, it meant paying cash for a car and never carrying a balance. To a millennial, it means keeping any savings at all, while renting with debt in a market like this. Same word, two completely different definitions of winning. Now picture this actually happening at Thanksgiving. Just cut back on avocado toast, one says. That's a rounding error against a 5 times bigger mortgage, the other replies. Neither one raises their voice. They're just doing math from 2 different decades. There's one more piece that quietly changes everything: timing. Half of boomers were married by 27. Millennials? Half aren't married until 34. The average age of having a first child moved later too, by about 6 years. That's 7 extra years of rent, one income at a time, before 2 paychecks combined to tackle anything big. Priorities didn't get worse. The clock just moved, which means every boomer milestone is being measured against a millennial who genuinely hasn't gotten there yet, not one who failed to. So here's the actual answer to the question we opened with. They were never solving the same problem. One generation was solving a housing market. The other is solving an entirely different economy. Nobody updated the manual when the economy quietly changed underneath it. Understand that, and the fight stops being a fight. It just becomes a conversation. If figuring out why people actually think the way they do about money is your kind of rabbit hole, there's plenty more of it waiting here.